Hit it.
Right now?
Yeah, right now. Hit it.
It's Friday, April 16, 2021, episode 127. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have the pleasure to welcome Ted Seides from Capital Allocators podcast. We have a fascinating discussion about his storied career, the wealth of wisdom that he has picked up over his years dealing with various hedge fund managers, and most importantly, what it was like losing $1 million to Warren Buffett. Then we are fortunate to have Patrick share his latest incantations in talking charts.
And this week in trading history, we go back to the market price action in the 2000s. We ended with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer are we drinking today?
So today we're drinking El Gringo Brewery's La Pachenga Cerveza, or Cerveza, depending on which part of the world
It's
you're
a
from.
nice looking can. I'll give it
Yes,
definitely
it is.
So it says here, La Pachenga means party, lively celebration. This authentic cerveza is light, crispy, and yet flavorful. The perfect Latin way of celebrating the good times in life. We
Tastes
kind
like
of
a light
need
beer.
this today after our announcement. So
It tastes like a light beer. Actually, it is 4.5%.
It's good.
It's good because you like it. You like it because it's tasteless.
I like it.
Do you like it, Lena? I think it's really good.
Mm-hmm.
I think it's a great beer.
Nice and smooth.
And it's got a terrific
Well,
logo.
if you like Bud Light, then you like this beer. This is
You know what? You're being way too hard on it. It's way better than Bud Light.
Yeah.
yes.
There's going to be
Because
some
it's not.
Americans
It's
that
hard
are
to be
outraged
worse.
right now.
It's hard to be worse. All right, give us a disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include archegos anal bleeding syndrome, Bill Hwang net worthectomy, and the frothy bubble boils.
All right.
Tongue twisters.
Yeah, there you go.
Big thanks to Alex for a couple of those, and then I stole one from the list. I'm not sure whoever that was. Thank you for sending it in.
Oh, thanks. All right, let's get to our interview. So we have the great pleasure now to be joined by Ted Seides from at Capital Allocators. Great to have you on the show, Ted.
Oh, thanks so much for having me.
Ted, it's Kevin here. I'm going to jump in. I got your book. I really enjoyed it. Why don't you just tell everyone your new book, the title and stuff? We'll get that over with.
Sure. The title is Capital Allocators, How the World's Elite Money Managers Lead and Invest.
Your book publisher be very proud of you, how that rolled off the tongue. I thought I'd start with your opening paragraph, and it's a quote. And it was a quote that you said, and it was, "Only a fool would enter lightly into a wager against the Oracle of Omaha, especially when he has put his judgment about an important investment matter to the test." So not everyone will probably know, but you are, if I'm not mistaken, you did do that, and you went and bet the Oracle of Omaha, the great Warren Buffett. Was it $1 million? It was a lot of money. I can't remember, but it was a long time ago. Why don't you tell people that story? Because I think it's a fascinating part of your history.
Sure. Yes, you are not mistaken. Maybe I was at the time, but we could talk about that too. So back in 2007, I made a bet with Warren Buffett that really pitted hedge funds against the market. That was the intent of the bet. And it was formulated as a portfolio of 5 hedge fund of funds that my partners and I selected against the Vanguard S&P 500 index fund. And so it was a 10-year bet starting in January 1, 2008, right before the financial crisis, through the end of 2017, with the proceeds going to charity.
Okay. And so can you tell me the 5 you chose?
No, we've never disclosed it.
Oh, okay.
And there are some not important reasons why, but the point was it was a diversified portfolio of hedge funds. It doesn't really matter who the 5 were.
And there was no way you were going to win. And so why don't you just walk us through your thinking and what went on, why you took the bet? Would you do it again?
Sure. Lots of different questions. I'll start with the last one.
Okay.
If you gave me the same set of precedent conditions today that existed January 1, 2008, I would absolutely take the bet again.
Okay.
So
And why is that?
Right. I put this in the camp of good process, bad outcome. So if you circle back to 2007, you had a set of market conditions. The market was trading at valuations that were historical highs. And let's keep in mind interest rates, short-term interest rates then in the US were, call it 4 or 5%. So you didn't have the argument that multiples should be high because rates are low like you do today.
Right.
So markets were expensive, and you could look at the S&P and say, based on history, when you start with a high valuation over a long period of time, you tend to get weak returns over that period of time. So that was one side of the bet. And the other side of the bet was hedge funds. And if you looked at hedge funds from that point in time backwards, what you would have found were a couple things. First, that although correlated to the market, hedge funds aren't that correlated to the market. They mostly march to their own drum to some extent. And so those returns had been equity-like for a long time, call it kind of 6 to 8%. It had been a little higher before then, but call it 6 to 8%. And you could expect that hedge funds more or less will do something like that, irrespective of what happens in the markets. So you could imagine 3 different scenarios playing out to simplify it. If the S&P 500 had a particularly strong period for 10 years, you would expect that the market would win because there's more market exposure. That's what you'd expect. If the S&P 500 had a particularly poor 10-year performance from there, you would expect hedge funds to win because hedge funds should march along and the market wouldn't be that good. And if you were somewhere in the middle and the market had kind of historically average returns and hedge funds kind of did what they did, then you'd have kind of a fair bet. And you'd sort of say, okay, do the fees matter that much? Can the hedge funds add value that make up for those fees and all those kinds of things? So Warren really was having a perspective of that middle group and saying, well, fees are high, you can't win. I looked at it at the time and said, you're not likely to be in that middle group of outcomes because the market was trading at such a high valuation. It actually felt like, and I still believe it is or was, an unfair bet in favor of the hedge funds. I just thought he made a bad bet because you really were comparing apples to oranges and one of them looked a lot better than the other at that point in time. So that was why I entered into it. It was mostly just kind of a fun thing to do and get to know him. And that's what happened.
Well, that's a terrific story. Did you end up going to Omaha and like having a steak over and chatting with him about it, or was it always over the phone?
Yeah, no, many times.
Oh, okay.
So I hadn't before we actually initiated the bet, but we pretty much did it every year thereafter.
Oh, that's terrific. Well, that's great. What's your biggest surprise about meeting him? Like, something that you didn't think about him before that you now kind of appreciate more or were surprised by?
I don't know about surprise as sort of the most interesting thing. I think having spent some time with him, what I would say is that he is like absolutely authentically the real deal. So he's incredibly brilliant. He understands businesses, obviously, but he's just sort of one of these people that can hold court on almost any subject with fantastic stories. But he's also this sort of kind, humble Midwestern guy. And I think the image that he presents through the annual meeting and in public is just an authentic version of who he is.
Oh,
and so I was a little bit skeptical about that at the time. I was thinking, he's so good at PR and he's really savvy, but no, he's a very, very special person.
Well, that's great to know because I was probably with you. I would have been a little skeptical. He seems like he swims with the sharks. You kind of figure he has to be a shark, but it's nice to know he's a nice shark.
Yeah.
Okay, so let's get to, you're talking about hedge funds, and you obviously have a background where it enabled you to pick those hedge funds, and you were part of the, I guess, one of the original, or not original, but at least early on, part of the Yale endowment kind of model with David Swensen. Why don't we step back and go through your career and figure out why you were in a position that you were making $1 million bet with Warren Buffett? So let's start. Where did you grow up?
Yeah, so I grew up in the suburbs, rough and tumble suburbs of New York City in Westchester County.
Okay.
Not that rough and not that much tumble. And had, my father was a doctor, my mother was a teacher, so not from the business world at all. Though I did have the actual rich uncle. So I had an uncle who passed away a couple of years ago, a guy named Jim Rothenberg, who used to be the chairman of Capital Group. And he was a West Coast guy, so I never really got a chance to spend a lot of time with him, but I was always interested in stocks from that background. So I went to college at Yale, and I took a class with David my junior year, and he had mentioned that they hire one person a year for their investment office. And
Right.
this was back in, I graduated in 1992. And I ended up there. I mean, that's a whole sort of regular person graduating from college, interviewing, getting some offers, not getting other offers, and thinking you're going to go to Wall Street and then ending up staying in New Haven.
Right.
And it was a fabulous experience. I stayed longer than I would have imagined when I joined. I stayed for 5 years and really learned how David invests at his feet.
Okay, so some people might not be kind of aware of the mystique, the aura of the Yale Endowment Fund. It almost created a method of investing, and I guess David Swensen was the originator of that. Why don't you just walk us through what that is and how it worked and why it was so different?
Yeah. So Yale's approach, like many approaches of, call it end owners of capital, think endowments, foundations, pension funds, comes almost from a place of deep humility, which is you have a small office, you're managing a large pool of money, and you're trying to compete in the world that's very competitive. So rather than try to compete in all these different interesting areas, go out and try to partner with the best. So you could call that a manager's approach. There were a lot of people who had done that. When he got to Yale in 1985, he looked from first principles at these pools of capital and saw that by and large, most of them were managed with underlying exposures that looked something like 60-40 or 70-30, but really U.S. stocks and bonds.
Okay.
And his thought was, well, Yale has essentially a perpetual time horizon. That's the purpose of the capital, to keep the university afloat for centuries. And if you have that long duration capital, you should be very equity oriented. They have very, very little liquidity needs. And you should be diversified, because diversification is the only true free lunch. But U.S. stocks and U.S. bonds are really only two assets, and that's not very diversifying. So what he did was he shifted the portfolio over the years away from bonds, so a very equity-oriented portfolio, and then diversified across equities in lots of different areas. So you could start with U.S. stocks and international stocks and add emerging market stocks. And then he looked at things like private equity and venture capital and hedge funds, with the idea of having an equity-oriented, less correlated return, and real estates and other real assets. So he wasn't the only person doing it. He happened to be one of the best at selecting managers and managing the capital. Where he grew to prominence was in, I believe it was 2000, so a little over 20 years ago. He published a book called Pioneering Portfolio Management. And in that book, he described Yale's approach, but he also did it in a very data-driven, sort of evidence way. It wasn't just anecdotes. And lots of other institutions then went through 2000 to 2002, which was a particularly poor time for a stock bond portfolio, and Yale continued to do very well. And other institutions used that as a game plan for how to change the structure of their assets. So he became known for the endowment model, the Yale model, and he was not the only person doing it. He was just one of the best.
He was smart enough to write a book.
Smart enough, or it's interesting because that book did two things. One, he really helped a lot of institutions form structure better portfolios and have a message that they could bring their governance bodies to implement. He also probably eroded Yale's competitive advantage in those alternative assets faster than anything else he could have done.
So the Yale people were probably pretty upset about that. So why don't you tell me what it was like working there in those early years? What did they have you doing? Just kind of walk us through those early days.
It was amazing. David is a natural teacher as well as just a great investor. So just being around him every day, going to manager meetings, you'd start to learn what kinds of questions they asked. By seeing how the managers came in the door, you sort of learned about sourcing. And he was a big writer. So every quarter for Yale's investment committee, we would write very detailed, very long memos about every investment recommendation and every update of the portfolio and do these very deep analysis of what Yale owned. So through that, you really grew an appreciation for what it takes for a manager to be exceptional, how to articulate your own thoughts, and how to communicate that to a governance board. And as it turned out, the people I worked with, by and large, have all gone on and been very successful in managing a lot of endowments, foundations, and a few family offices.
That's fascinating. So, Ted, you weren't happy enough going just to one prestigious school. You then quit and went off to Harvard. Am I correct? You decided to make your parents proud by going to two.
That was probably the only reason, but yes, I went off to Harvard Business School.
So, why was that? What were you looking to do? What degree did you get? Walk us through that part.
Yeah, so it was an MBA.
Okay.
I thought I wanted to pick stocks. And I wanted to learn a little more about the fundamentals of business analysis, which is quite different from the fundamentals of manager analysis.
Okay. So you went
on top of that, I wasn't 100% sure. I loved what I did at Yale. I loved the people I worked with. And what I did was I talked to the people I knew, which were a lot of very successful money managers and the board at Yale. And what I kept hearing from all of them is if you get into Harvard Business School, just go. Okay. Don't ask any questions. Just go, and you'll understand why later. And I did, and I understood why later. So that was my next 2 years.
Okay, so you go to Harvard, and why should you go? Like, could you put that into words for us?
Yeah, there's something very, very special at Harvard about the structure of the first year classroom, where you're put together with a group of 80 of your peers. And you're in your own classroom. The teachers actually come in and out of the same class and you sit in the same seat. And you just get to know this community of people and how they think in a way that doesn't happen at any other school. And of course, the people that they have in the room with you are all really exceptional people. So it's really for the people and the relationships you form more than anything else.
So out of school, what do you do from there? Do you go back to Wall Street?
I never really was on Wall Street, but I worked for a couple of funds that Yale had money with. So one, a summer job at a hedge fund back in 1998, who was a value fund, terrific fund, Brahman Capital. They're still around, a couple billion under management. They were, long value stocks and short these ridiculously overvalued things like Amazon and Starbucks and a couple other things. So they had their best day in their history. They had started a number of years before the day I arrived. And then I think in the 6 weeks I was there, they might not have had another up day. So it was pretty, and back then, a blow up was considered down 8 to 10%, not like what we experience today, but it was rough for them. And I decided that I really wanted to learn business analysis at a deeper level. So I ended up working at two different private equity shops that Yale had money with. And after a couple of years, I'd never really found my footing in that. And just decided to go back to the manager selection side of things.
Okay, so when you did that, did you go hook up with some old partners? Did you make your own? I can't remember. Somewhere along here, you make your own firm. Is this the point?
That's pretty much the point. So I could have at that point in time. It was I could have gone back to Yale at that point in time and decided I hadn't really made it in the world, so it wasn't time to go back. And I got introduced to my former partner by a couple friends. And I was sort of he and I started a hedge fund of funds called Protégé Partners. We were investing in sort of smaller hedge funds and seeding hedge funds across strategies. And that fund started in 2002, and had a great run. We grew it to just under $4 billion in assets at the peak sometime in 2008. And it was still about $2 billion in assets when I left in 2015.
Was the edge there that the larger pools of capital were allocating to established hedge funds and therefore picking the new ones? I think I've seen a stat where hedge funds' best performance is often at the beginning when no one's invested in it. Was that the idea behind choosing those kinds of managers?
Yeah, it was called Protégé Partners for a reason, right? We were looking to invest in the protégés of great fund managers for just that reason. And it was a different time, right? Back in 2002, most of the large funds were closed. And we had buckets, like we would tranche our portfolio and say we were investing in small funds and medium funds and large funds. And the large fund bucket in 2002 was north of $1 billion. To just give you a sense of how that's changed. And that was, the funds like Farallon and Oxif and all these funds that from that period on, really after that 2002 period, for the next 6 or 7 years, really grew substantially more than any hedge fund had in the past at that point in time.
So now you've sat in on a lot of pitch meetings. People, at different hedge funds have tried to, convince you to invest with them. What do you think is the number one attribute in terms of what makes a great portfolio manager?
Yeah, there is no one attribute. It's a complex decision process, and people use different tools of alliteration, right? There's the 3 Ps: people, process, and performance. I have some of this in the book. There's like the 4 Cs, the 5 As. It doesn't, you can call a whole bunch of different things. There is a set of precedent conditions that any manager that someone's investing in, you want them to have a very clear investment philosophy, a set of reasons why they have a competitive advantage, the team in place to make that work, and their whole investment process that's really thorough. How do they find and source ideas? What kind of homework do they do? How do they go about making decisions? How do they construct portfolios? How do they trade around names? All that kind of stuff is table stakes. Once you get past the table stakes, then you get into things like someone's character, their alignment of interest with yours, and really their judgment. And those are a couple of those kind of key components, no one of which is, I can't tell you there's one thing. If there is one thing that you come back to after all of that, it's character, because you give money to someone, you're not sitting in their office every day. You're not telling them what to do. You just need to make sure that they're going to do right by you.
And in terms of obviously some managers come and go in terms of the popularity of their strategy. And when you're thinking about this, how many times do you go and think, okay, this strategy is great right now, but this doesn't have kind of staying power, and like walk me through kind of how you're thinking about alpha, that you're not worried is going to disappear, that they're not going to just be a flash in the pan.
Well, you have to go into any investment. This is, by the way, no different than when you're picking a stock. You have to go into any investment with a fairly well-articulated thesis of what you're trying to accomplish.
Okay.
So I can't give you a rule of thumb across all managers, but there are some managers you invest in because you think it's an evergreen strategy. There are others you might invest in because you think it's a particularly tactical time to be investing in that strategy. When that plays out, you might want to exit. And there are others that you're investing in because you think they're in a sweet spot of where they're investing and the trajectory of their business, but that could change over time. And if it changes in ways you don't like, you'll reassess at that time. So all of those things go into that initial decision. And then you get into the same tenets of a good, sound decision-making process that you would with a stock. Sort of, what's your thesis? How are you revisiting that thesis? How are you making sure you're staying apprised of all the risks that play out, and then reassessing your decision over time?
Do you believe that there are evergreen strategies that managers that can deliver consistent alpha for years, decades?
Yeah, there are these things called venture capital and private equity and equity investing, lots and lots of evergreen strategies.
Okay. So let's talk a little bit about private equity and venture capital. Sometimes, in terms of private equity, there's an argument that some people make that it's just levered up beta, and that it's not really, once you kind of take out the leverage on it and look at it after fees, that it's not as attractive as it's made out to be. And it's had this huge tailwind of, multiples that have been expanding due to interest rates coming down. What would your pushback be on that?
Well, there's a lot of ways of pushing back on that. The first is, I would say, let's say you and I don't know. We have a situation today where we all understand that valuation multiples are high, public markets and private markets, and yet there's lots of money going into private markets. And in active management of public markets, on the margin, that money's getting taken away and going to passive. So that means one of two things. What we're experiencing from this allocator community is either the wisdom of crowds or the madness of crowds.
Okay.
And to say, which I think is fair, people could say if you look backwards, it's really only leverage, it's only this, that you could make that argument. It's far too simple of an argument to make based on numbers and data without really understanding what's going on. So there's a lot happening in a private equity fund that is superior to public market investing. So for example, if you give someone money and lock it up for 10 years, you will do a lot better than if you give someone money with the decision to exit any point in time between now and 10 years from now. And we just know that. That's like a tautology of investing, that people make bad decisions and get in their own way. So structurally, private equity is set up to do better.
Isn't that kind of ironic? It's like the same reason that real estate ends up doing well, because you don't get a price flashed at you every day in terms of what your house is worth, and you can't get in and out. So it ends up being that people stick with it for longer. But meanwhile, the stock market is flashing every day, and it's made it almost too easy to get in and out.
Well, I don't think it's ironic at all. I mean, if you study as we all do who invest in the public markets, just decision-making theory and behavioral finance and bias, like we understand that we're all wired to make bad decisions. So in fact, if you then take it from there to the institutional perspective, what you find is it's not just one person sitting in front of a computer who's making a decision to buy or sell, right? So you have a portfolio manager that has to fight these biases. You then have their client. So let's say that's an investment office at Yale or something like that that has to fight those biases. You then have a board that Yale's team reports to ultimately makes decisions. And in some of the other institutions, you also have a consultant somewhere in the way. So you have in between that one decision of that particular stock and where the capital is coming from, you may have 3 or 4 layers of people making decisions that are just going to compound the challenges of making any one decision well along the way. So it's not that big of a surprise that if you strike out all of those layers of decisions and just say we're investing in this for a long time, you'll do well, because that's just structurally set up to avoid human bias.
But couldn't you do the same by having, allocating to an equity, a value manager that requires a 5 or 10 year lockup?
Absolutely.
Right.
Absolutely.
Okay. So that sort of structure wouldn't bother you, like as an allocator.
No, nobody does that, though.
Oh, that's funny.
Right,
Actually,
why?
I stumbled across a place in Toronto, a couple of guys in Toronto, and they were the same. They were that way. It wasn't 5 years, but it was 3, and then if you went 5, they changed the fee structure. And then the whole idea was that they wanted people that were going to stick with them for the long run to counteract this tendency to pull money at the worst time.
Yeah, I think they'll have an advantage over someone who has a shorter horizon, but I've experienced that with hedge funds, right? Because hedge funds, some have quarterly redemption, some it's annual, and then some you'd lock up for 3 years or even 5 years. And what you find is that at the end of that period of time, there's a decision point.
Oh, okay.
And if the manager happens not to have done well in that quarter before that decision point, if all of their clients are deciding at the same time, it's not very good for their business. So you've seen there's lots of pluses and minuses. The point being, the longer you can extend that time horizon, the better it's likely to be. And in private equity, you've extended it for 10, 12 years. There's nothing in public equity that looks like that today.
That's interesting. One of the things that often I think that retail people that are in the market on their own, they think that they're the only ones that make mistakes, and they think that the institutions are all these smart, omnipotent beings, and they're not prone to these biases. And what I'm hearing, and I know that I've experienced, is that they're human beings just like the rest of us, and they're just trading with bigger numbers.
Well, they certainly are human beings. I do think their resources are different. Their level of expertise is different. I just had a show come out this week that's gone gangbusters with a hedge fund manager named Yen Liao, who said the biggest difference between institutional investors and retail investors is sell discipline. And that's one interesting theory, but there are huge differences in the institutional marketplace and a retail investor.
Sure, there's huge differences, but they're still subject to the same biases, and that they still make a lot of the same mistakes, and just in slightly different ways, and with a little bit more knowledge, or they're working harder to offset it because they are aware of it. But being aware of it might not be enough.
Yeah, that's right. No, they're human beings.
Yeah.
So yeah, I would agree with that.
Yeah. So one of the things that you just mentioned is your podcast. Why don't you tell us how you came about doing the podcast, and kind of just give us a little flavor on how that's been and your experience on it.
Sure. Well, after 20-something years being in the institutional investing world, I wasn't sure what I was going to do when I left Protégé. And I took on a couple projects, but along the way, I had this idea to run around and talk to some of my old friends and just share those conversations. Really no objective at all, no goals attached to it, just a fun, productive use of time. And that became this podcast. And in fairly short order, it got some attention. And I guess just from being around the business for a long time, I have a lot of friends in the business. And there are a lot of people that don't really come out in the public eye, not because they're afraid to or anything like that. There's just no purpose for them to do that in their jobs. And so, the first 50 episodes I did, something like 45 or 46 were friends from the business. And I quickly realized that a lot of the chief investment officers of these big pools of capital, first of all, they're not polished in how they tell their story, because they're unlike a fund manager who's marketing and telling their story repeatedly. They almost never are on that stage to tell their story of what they're doing. So that's kind of a fun dynamic that you really can get real insights, because they don't have an agenda, an objective, and they're not guarded in what they're willing to share.
That's right.
The other thing I learned quickly, was they don't get a chance to hear each other very much.
Okay.
Because for the same reason. And so that came from a longtime dear friend of mine, Jim Williams, who runs the Getty Trust, had heard a conversation I had done with Scott Malpass, who's a recently retired chief investment officer at Notre Dame University. And they've been friends for decades. And Jim said to me, wow, I learned so much in that conversation. And I said, Jim, what are you talking about? Like, you guys talk all the time. And he said, yeah, but I've never had a chance to hear his whole story.
Wow. I stumbled upon it early, and I have recommended it when people say, I'm interested in the markets, I'm interested in portfolio allocation, and I'm interested in learning more. I always put them to your podcast, because I as well have learned so much about how all these very serious students of the market or allocators of capital, how they work, and it's been a fascinating behind the scenes look. And I just want to thank you, because I find it's just, I eat it up. And that Scott Malpass one is one of my favorites. I don't know. I can't remember why, but I know that was one of the ones I went and listened to twice and took notes on. And it's just a fascinating thing. Is this book? I take it, like, I have the book, and it seems to be, it's almost all the wisdom that you've learned from these podcasts over the years.
Well, that was the attempt. Yeah. And first of all, thank you for those recommendations. I really do appreciate it. I got to the point from doing these conversations. For a while, I could remember off the top of my head, Scott said this and Jim said that, and it was just really fun. But after probably, 50 or 60 episodes, I couldn't remember all the little nuggets in my head.
Right.
And after 100, I really couldn't remember the conversations I had, and I started to get embarrassed by it from time to time when I talked to these people again. So now part of what happened also is, once the podcast turned into the hub of a business with a lot of spokes around it, I started investing my own capital again. And I started to think that there were a whole bunch of things I had learned that I wanted to make sure I had on my desk as my own checklist for investing my capital. And so that's why I started writing the book. That started with everything I had learned about decision-making from people like Annie Duke and Michael Mauboussin. And I just wanted to take those conversations and kind of literally turn them into my own checklist. And I went from there, and I started it with that, and then a bunch of quotes. I had a few terrific interns join me that helped me go back to all the episodes and outline them through quotes. So we had 3,500 pages of transcript. It turned into 850 quotes. And from that, I was able to sort of pick out some topics that were streams across episodes and write up a couple chapters about that. And what was left over, I curated into some kind of subtopics related to investment lessons and life lessons, and just put them in as quotes. So the last third of the book is called Nuggets of Wisdom. And it is my favorite part, and I've already gotten some great feedback about it, that it's just these phenomenal quotes about investing from the guests themselves.
I'm going to get to that at the end, because I would love to get your kind of feedback. I'll give you a quote, and then I'd love to get your feedback and kind of a little bit of color on it. But before we do that, you mentioned that you started investing your own money, and I actually stumbled upon another one of your podcasts where you talked about this, and you talked about what you've been investing in recently. I would love just to kind of, for you to flesh that out a little bit, talk to us a little bit about what's attractive right now and some of your ideas. One in particular is the SPACs. I've been fascinated by this as well, and I suspect that people probably don't understand how you're executing this strategy and why, and maybe you could give us some background on that.
Sure. Well, the core of what I do comes from a place of kind of a long time horizon mindset. And I'm not, although I do own a little bit of index funds, I'm not wildly enthusiastic about what the markets will deliver. So within that, I guess you could call it thematic, but it's really a series of manager selections. So I have a fair amount of exposure to biotech and some technology. Some of that's direct stocks. And just, I'll own Google and Amazon, nothing fancy. And where I really have my comfort zone is in managers. And so I've done a fair amount in private equity. So some in funds and some in kind of direct co-invests. And then in managers. And then along the way, really last fall, I started paying a little bit of attention to SPACs. And I don't do this very often, but it was pretty apparent to me pretty quickly that there was an investment strategy that was likely to make money with fairly low risk. And what that was buying the SPACs and waiting for deals and then selling them. And up until about 2 months ago, it felt pretty foolproof. I mean, I was buying SPACs, but between, then it was about, call it $10.25 and maybe up to $10.60. And every time they announced a deal, they were going up 25%. It was a little irrational because you have a pile of cash for $10 that all of a sudden is trading for $12. But there were reasons you could articulate as to why that might be the case. So I just, for the first time in my life, I had created a portfolio that was all in leverage. You knew exactly what your downside was, which is $10. And I felt like, oh, that's pretty easy to lever up. I'm borrowing even in like my retail brokerage account at Schwab for like 3%. And that was working pretty well. Then I got excited about it, and I started more recently when that whole premium, so that $10.50 to $12, all of that's come off. So almost the entire SPAC universe now trades at $10 or even below.
Right. There's a lot that are trading below. There's actually a positive yield to maturity on many of them.
So in certain, and now there's more discrimination on the announced deals. So some deals, nothing happens, and some of them, they do pop.
Right.
So I started buying the warrants attached to the SPACs, which are often trading less than $1, struck at $11.50. So the thought is, and they're 5-year warrants. So if somebody goes and does a deal for a good company, you've got 5 years to make 25%, 5% a year on a good deal. And some of these pop right away. So that's pretty interesting risk reward as well. And then more recently, since that, things happened that, like my most recent trade, that I didn't see coming at all. So the most, or certainly one of the most successful and popular sponsors is Chamath Palihapitiya, who I had on my show in January. And Chamath's done, I think, 3 deals that have all done extremely well in the market. And then he has 2 they haven't announced deals that, 60 days ago were trading at $14 and $15, and now we're just above 10.
Right.
And so I've rotated a lot of what I owned into Chamath SPACs, and now it's very quiet. Like, no one's heard from Chamath for a month or so. And my guess is at some point in time, he'll announce another great deal, and there'll be a big pop on that, and I'll probably trade out of it then. And at some point in time, I'll just say no mas because it's taking up too much of my time and move on. But it's been fun. It's fun for me to participate in the markets. Again, I'm not doing it from a perspective of business analysis. This is really a series of trades.
Do you worry about the SEC's been doing, issuing some warnings about this? And I would love to hear, is that something that concerns you or no?
No, not at all. So there's two areas of concern articulated by the SEC. Okay. One is that because of the nature of these transactions, the regulatory oversight occurs at the SPAC sponsor level. And then if that SPAC merges into a private company, there may not be great disclosures of that private company. So that's a concern. I'm doing this with sponsors. There is a manager selection element of this for me. Like I know the sponsors of the SPACs that I'm buying, and so I'm not too worried about that with those particular sponsors. The more recent one is sort of the accounting treatment of the warrants, and that's accounting. It's noise to some extent. The economics of the underlying situation doesn't change based on the accounting treatment.
I didn't realize that. What's the issue there? The SEC's flagged something about the way that they're doing the accounting of those warrants?
Yeah, the SEC is pushing for the warrants to be treated as, if I get it right, like as a liability instead of as part of the equity.
Okay.
But it's just an accounting entry.
One of the things that I worry about when I look at this strategy is it's a lot of it is based upon that pop that you mentioned. The chance of the deal being worth more than the $10, and you get the pop. And if you buy a portfolio of these, let's just say you buy 10 of them, 5 of them end up being pushes, 3 of them pop enough, and 2 are kind of explode higher. And then you look at this, it's a great return on a portfolio. But it seems to me that there's been so much hype, and there's so many people that have invested in sponsors and SPACs that were probably not really deserving of where they were. And as they get hurt, it'll be more difficult to get the pop. So therefore, we're going to find a situation where, as you're looking at this from a portfolio point of view, that people that are buying it are overestimating the chances of the pop. And I was wondering, what would you say to me, putting that concern out there that I think that there's a chance that the investors in SPACs are overestimating the positive upside based upon previous results of the last year.
Oh, I think that's entirely possible. But I don't know how, right? That's a very qualitative assessment. The only thing we know today is that your average SPAC trades for probably between $9.90 and $10.
Okay.
And your downside of that trade is $10. To me, that's a lot of upside optionality and very little downside.
Except
on an absolute return basis. You might not make any money, but that's fine.
But one of the worries that I have, though, is if you're doing it with any leverage, and it's, let's talk a little bit about Archegos. I don't know how to say the name, but we're seeing that there's more leverage in the system than we ever thought. There's a chance that maybe there's more leverage in this market, and if there was something to go wrong, we could have a situation where we have fire sales.
Yeah, I mean, look, I think the corollary to this, to the risk in the SPAC ecosystem, is what happened in early 2000, where you had private companies going public that weren't yet proven as businesses.
Okay.
And the public market was placing a high valuation on those businesses, but ultimately the businesses proved worthless. So think about a pets.com or something like that. Yeah. What you have here is a situation where you've had a massive amount of shift in the number of companies from the public markets to the private markets over the last 10 or 20 years. And now you have a window of opportunity for private companies, generally held by venture capital firms or maybe private equity firms, to go public. If someone gets hurt, it will be the public markets placing, for some period of time, too high a valuation on a business that isn't worth that. And it certainly could be the case that sponsors who have incredible incentives, economic incentives to just get deals done, do deals at high valuations that then the public market decides aren't worth it. So I think that's entirely possible, but it'll all happen in the public domain. So like when I talk about leverage that I'm deploying, I'm buying cash SPACs. Let's say I buy a portfolio of SPACs that are, let's just for argument's sake, say I buy 10 SPACs that are $10 and there's $100, and I just happen to have a whole bunch of other assets that I can borrow against, and I'm just borrowing the $100. My downside in that is I lose my cost to carry 3% a year. I know contractually that I can get my $10 back.
As long as you could make it through the margin calls, in essence, right?
Yeah, but that's on me,
yeah.
Right? That's on me personally. It's not. So my point is that doesn't create systemic leverage for the SPAC sponsors. There's no leverage at that level.
Oh, no,
I'm just creating it myself.
I completely agree, and I'm not worried about that at all. I'm worried about the portfolio clients that are buying, the SPAC arbitrageurs or SPAC speculators that are buying a bunch of this. Why don't we talk a little bit about this recent GameStop and the rally that we saw there that was just unbelievable. And one of the things that, you've had a front row seat to the long short hedge fund. You were probably investing in this asset class before almost most people even heard about it. And the game has obviously become a lot more difficult in the last 6 months, based upon this GameStop squeeze. Is the long short hedge fund dead, and is that good, or is this going to actually maybe be the final terrible results from these guys that makes it so that it's the time to invest in these things is now, because for once you're actually getting paid for the risk of being short something?
Yeah, it's very hard to generalize. I wrote a research paper now 11 years ago called The Surprising Cost of Volatility that talked about why I thought shorting was going to get increasingly difficult. And when you have single stock volatility, it makes it extremely difficult to monetize shorts. It was one of the this is a paper that sort of came out of 2008, 2009, and what you saw was across different types of capital. So even endowments that drew down and then bounced back. 2008, 2009 combined was maybe a one standard deviation event. But because of the path dependency on it, when you go down, you don't know you're coming back up. It causes people to act at the bottom.
Okay.
And so without going through the math, the challenge in shorting is the same reason why levered ETFs generally lose money over time. And the providers of leveraged ETFs will tell you that they only, quote unquote, work in terms of leverage on the underlying exposure if you're a day trader.
Right.
If you hold a leverage ETF, and there were great examples in the financial crisis, if you held a leverage short ETF through the financial crisis, you lost money. If you were long the levered ETF short, you lost money. So what happens is, and it's a rebalancing issue. It's sort of what happens if a stock moves up and down, because if it goes down 50%, you have to make 100% to make it back. It causes you to sort of consistently, when things are bouncing around, sell. Let me get this right: sell low and buy high and sell low. So there are a whole bunch of dynamics that make shorting much harder than they were. The level of interest rates is one of them. The crowdedness of shorts is another. I like to tell the stat. When I worked at Yale, what we considered a crowded short was generally something like 2 to 4% of the float outstanding. That was crowded. People just weren't playing the game. So it's a different game. This dynamic with, call it crowdsourced trading. Eric Peters on my podcast called it crowdsourced convexity, which I love, right? You're creating convexity from these crowdsourced trades. It's just a different dynamic. I don't think it's a systemic thing. But shorting, this particular case was fascinating for a whole bunch of reasons, The lessons of investing end up being the same, and you alluded to one earlier, right? Leverage can be a real cause of problems, and we saw that with Melvin. And leverage and concentration is sort of the worst recipe for disaster, which we saw in this Archegos. So those aren't new lessons, but I do think the nature of people being at home because of the pandemic and trading like it's a game, and all of the ubiquity of information and crowdsourcing makes the path dependency to be right or wrong on a position, say right on a short position, so much harder. But that's not actually new. It was just sort of it was just highlighted again. So I think long short, the standard kind of Jones model, A.W. Jones model of a long short fund, has been under pressure as the kind of optimal structure to manage capital for a number of years. And this was just yet another example of it.
Okay. So let's go on to your investment lessons. I'm going to throw out quotes that are at the back of your book here, and you could just comment on them. So this one's from James Atkin, terrific guy. It's not just the non-predictable regime shifts that cause abrupt moves in any financial instrument. It's the over-reliance on short-term market financing to underpin positions. Mm-hmm. Do you have anything to say?
Oh, I mean, so yeah. Do you want me to?
Yeah, just
yeah. I mean, it's a sort of a fascinating comment. So James is an expert in understanding the plumbing of the financial system, and his thought is that it's not just the positions like we're talking about, but it's how they're financed. And so, one of the big lessons back in 2008 was that hedge funds, for example, have counterparty risk. And what we saw with Lehman were, funds, ironically, including Bill Wong's Tiger Asia at the time, was mostly Lehman exposure, and they got caught. So focusing on how positions are financed, particularly in leveraged situations, is incredibly important.
Okay, here's one from Scott Malpass, and it says there might be 50 or 60 investors in the world who can really do this model well. Do you believe that?
I do. I mean, it's a classic inconvenient truth because there are so many more people out there trying. Now, there is a question in that quote. You said, do I believe that? He said, this model. You have to deeply understand what this model is. And for Scott, that means a global portfolio of small, off-the-run, well-known, outstanding managers that other people aren't finding that add significant value over time. To do that, you need an army of people who are very, very smart, very talented, and well compensated. And there just aren't that many pools of capital that are set up that way.
Okay, here's one I like. Andy Golden says, being contrarian means you have to be able to do some uncomfortable things.
Yeah. So we all like to talk about being contrarian, but it's really only when the proverbial shit hits the fan that you know if you are or not. There's a whole slew of quotes I've had from people on the show that talk about like being contrarian means you have to be like wrong for longer than other people and still make it through. There's a whole bunch of those. But yeah, that concept that you're not actually a contrarian unless it really hurts. And hurts doesn't mean like I feel bad. It means like my business is at risk. My capital is at risk. I'm in trouble here. And the existential risk of being taken out of the game, or another great Andy Golden quote, to finish first, you first have to finish.
Another one that's along the same line as Larry Siegel that says Baron Rothschild said about 200 years ago, buy when there's blood in the streets. But we usually forget the second half of his aphorism. I can't even say it. It was, even if the blood is your own.
Yeah, exactly. Right. So when there's blood in the streets, it's usually not just other people's blood.
That's right. Even when you know a crisis is coming, you don't want to believe it's coming, so you have trouble acting. That is just a basic lesson of human life. That's Emanuel Friedman.
Yeah. Yeah. It's tough, right? It's easier to talk about market cycles than to be in them and act the way we would like to act. Like people that do it plan, they structurally plan out ahead of time how they're going to behave so that their own behavior and emotions don't get in the way when it's time to act.
Michael Mobosson, I don't know how to say that last name. The biggest mistake in the investment business is a failure to distinguish between fundamentals and expectations.
Mm-hmm. Yeah. So Michael wrote a book called, his first book was called Expectations Analysis. So it's a question of, it's not really all about absolute returns. Sometimes it's about relative returns and understanding not just what you know, but what everybody else knows. And the difference between those is what drives success in investing.
Here's one from James Atkin again, and I would love to hear how you interpret this. What makes a great fund manager is that they are long time. They are never short time. They never give their time away. And I don't think he's meaning the actual time. I think he's talking about time to make an investment work. Am I right?
No, he's actually talking about their own time.
Oh, they are. He is.
How they spend their own time. Yeah.
Oh, wow. And so he thinks that's that important. Do you agree? Do you think that ends up being one of the most difficult things in terms of managing money and like figuring out how to work out the time and not get stuck on little things?
I mean, you can get pulled in lots of different directions, and the more successful you are, the more people will pull at you. So it is, managing your own time, being productive and thoughtful about how you plan your day, your team's day, how you're spending your time. Time is the most precious resource in life and in investing. So I do think that's incredibly important.
So here's one from Jonathan Tepper, who I'm a big fan of. He says, macro has an emphasis on gurus. It's a crystal ball in a black box. And I think that is a difficulty there. And then too often there is one particular lead manager that is kind of the face of it all, and it doesn't end up being as much of a process. Would you agree?
Yeah, I've never invested much in macro. David Swenson wasn't a fan of macro. We didn't do it much at Protégé, and that's part of the reason why. Scott Bessent, who was a partner of mine at Protégé and has his own firm now, ran Soros for a while, used to say that macro is a slugging percentage business and fundamental investing is a batting average business.
Okay.
In baseball terms. And the problem with the slugging percentage business is you never know when you're going to hit the home run. And so what tends to happen is you strike out more than you hit home runs. And when you've struck out a few times, the clients leave just before you hit the home run. So it's a very, very difficult business to underwrite.
Do you think that that's going to change if we had a change in kind of a secular change in the way that governments behave? Like, I have a theory that we're going from a period of monetary dominance to fiscal dominance, and in that kind of shift, there might be more of a chance for macro investors to shine. Would that be enough to overcome that, or no? You still think that it's still going to be a slugging kind of game?
Yeah, I mean, I think it's structural, and what Jonathan said is right, which is that the success of a macro fund is entirely dependent on the person who's making the trades.
Right.
And, it's very rare. Like when institutions talk about having a portfolio of macro managers, that's actually synonymous with investments in Bridgewater. They really don't. There are very few places that have like a portfolio of macro managers and they understand how they invest and how they underwrite them. And I think that's quite different from fundamental investing. It's a very difficult business to do anything but just bet on the person.
I'm going to go with the final one here, which just kind of made me laugh. And I'm wondering if you've ever come across this person. He said, if you can find an optimistic fixed income guy, I'd love to meet him.
Well, particularly distressed. I just finished reading a fantastic new book called The Caesar's Palace Coup that was Max Frooms wrote it. It's about the Caesars restructuring and has private equity guys in it and Apollo and distressed debt guys. And you read that book and you say, no. There are no friendly people in those rooms.
Okay, so we're at the stage where we're going to wrap it up. Now, I often ask my guests a couple questions, and I learned this from you. Actually, I'll say, pull no punches, that I found this from you, and I kind of adopted it. And I was going to ask you a question that was the same as the ones that you ask your guests, but I'm going to ask my own and keep you hopping a little bit. And so the first one's going to be, can great portfolio managers be made, or are they born?
It's a little bit of both. They can certainly be made. And I would say portfolio managers, distinct from analysts, is a whole separate thing. But no, I think that there are training grounds for people to be portfolio managers and really learn the skill. But on top of that, there is an element of nature in the sense that it requires an even temperament and disposition. And I think some of that can be trained, but a lot of it is innate.
Okay, my next one, I'm going to ask you for your best trade and your worst trade. I know you're not a trader, so maybe you could talk about your best investment, worst investment. And it doesn't need to be yours particularly. It could just be something you allocated to, or just a good story.
Yeah, I mean, I'll share one of each, and it's probably easier for me to do the extremes, which are going to be in my professional career more than my personal side. So the best investment I ever made, we were the largest first-day investors in John Paulson's subprime mortgage fund.
Wow.
And we had been short high yield for a number of years in our fund and through managers, and wrong about that, and then came across this thing that had an incredible risk reward at a time when the rest of the portfolio was kind of humming along. And it was the best. Like, I never slept better in my life, because if it didn't work, the rest of the portfolio was going to hum along. If it did, and it did, you knew you were going to do really well. So, we did extremely well in 2007 and protected capital much better than our peers in 2008, in large part because of that position. So that was a good one. On the other side, we had an investment in a terrific multi-strategy hedge fund that was part of Ross Perot's family office in Plano, Texas. And terrific group of people. They had all their capital alongside of us. And in November of 2008, they had taken some losses, and they had it was all kind of fixed income arbitrage. So again, the question of leverage. And they had a position in the commercial mortgage space where they were long paper that traded to a level that had it sort of played out fundamentally, something like 80% of all the commercial properties in the U.S. would have defaulted with next to no recoveries. Like it was sort of impossible from a fundamental basis, but on a technical basis, they got completely carried out and the fund lost all of its money. So that was happening at around the same time as Madoff. And, people who invested in Madoff got a lot of their money back. But in this fund, it literally went to zero. And Ross Perot was in the papers at the time. He had lost $400 or $500 million from it. The principals had all their money in the fund. They lost it, changed lives in a negative way. And it was, it was the worst outcome. I don't know if I would say it was the worst investment, but it was certainly the worst outcome I ever experienced.
Oh, those are two great stories. Now, well, not great, but the second one's not so great. But the first one, I love hearing about that. Did you guys cash out or did you stay with them afterwards, Paulson?
So the first liquidity date was at the end of 2008. And so that fund started in the summer, maybe it was early fall of 2006. And it was a 2-year lockup to let it play out. So it was the end of 2008. And at the end of 2008, everybody needed liquidity for their investors. So we took out all of our money, which was, fortunate. He did well in 2009 and he had some troubles after that. But yeah, it was, we got it right on both sides.
That's terrific. Okay. So Ted, why don't you tell us people where they can find you? Give us the location of your great podcast. And most important, tell us about your new book.
Thanks. So everything I do is encapsulated in a website that is capitalallocators.com. There's a really cool mailing list that is free. People can sign up for. And I send an email out once a month, so we don't kill people with emails. People get plenty of interesting emails. And we have premium content there and a whole bunch of other stuff. Podcast is on any feed, Capital Allocators as well. And the book is called, shockingly, Capital Allocators. It's available on Amazon or anywhere else.
And it's not your first book. You actually had another book in 2016.
It's not. It's the first book I really like. My first book I like. So when I left Protégé, I knew I wouldn't be spending my time investing in early stage hedge funds. There's a bunch of reasons why. But I had learned a lot and I had seen a lot of the mistakes that portfolio managers make because generally speaking in that space, people don't start multiple funds. And so someone's starting a fund for the first time, they might make the same mistake somebody else did. So I wrote effectively a series of case studies about some of the lesser known. This isn't like go to your prime broker and get an office and buy a plant. It's, I think there was one chapter called the two-headed portfolio manager monster. So you talk about like why you never want to have co-portfolio managers when you start a fund. So there are probably 25 of those types of lessons, and there are anecdotes in there of actual funds. Some of the names I had to change to protect the guilty.
Right.
And it's called "So You Want to Start a Hedge Fund: Lessons for Allocators and Managers."
That's terrific. Well, thank you so much for your time, and thank you for your podcast. I've learned so much in it, and it's a pleasure listening to you all the time. Thanks again, Ted.
Thank you.
Okay, Patrick, it's time for Talking Charts. What do you have for us this week?
Okay, well, as always, we're going to first start off just talking about the top three. Let's start with what we talked about last week. And so I have it here listed. We were talking the economic data and bond supply that came out. What did you take away from last week or this week's stuff?
Well, we had a great bond rally in there. So the reality is that, that the low might have been made into the actual supply.
Yeah. Well, the other thing we were talking about, number 2, was Boeing. It's interesting because they continued to find little electrical problems this week, and the stock weakened off of its highs. But realistically, it's not really selling off very hard at all on this news. I still actually don't think my view has changed at all, which is that the stock is really baked in most of all of this bad news. And
it's a snooze fest. Nothing's happening.
Yeah, exactly. And so, and then the last thing we were talking about last week was whether that was a breakout in the commodity index. And so, let me just quickly pull up that chart on the commodity Bloomberg Commodity Index, and it has followed through. I mean, it hasn't broken to higher highs, but we certainly
chugging away. It's chugging away.
I agree, and so we definitely have but the big question here will be: will it break to higher highs? And that's something that we're going to be watching for. Because I mean, at this stage, it's nice that it followed through, but so oil kind of popped a little bit higher, and a few of these other things. We'll talk about some of these charts in a moment. But let's talk about the top 3 things to watch next week. And so the first thing that I wanted to touch on at number 3 was just: are we finally going to see the biotechs break out? Like when we go through all of these different subsectors, so many of them are making fresh new highs. So many of them turned around. And the one area that we just, since February's highs, just can't get any momentum or tailwind is the biotech space. But it's put together 3-4 days trying to reverse off of retesting a key support line. And one of the things I'm going to be watching this week is whether or not the bulls can finally break this out and get it off the mat. Have you been watching the biotechs at all?
I haven't been watching it, but I don't know why you're so excited about it. It doesn't.
I'm not excited yet. I'm watching it. This is not the top 3 things to watch.
I don't practice the dark art, but to me, it looks like it's going down.
You know what? You're the one who always gives me shit about the fact that that technicians chase charts. But when you give something that's just at the beginning of the move, it's not impressive. I need it to first go much higher before I consider it a good trend in buying it.
To me, it looks bearish.
Oh yeah,
that's all I'm saying. I'm wondering.
All right. Well, you know what? I sold to you. Maybe that's where we're going with this.
Patrick, you're gonna have to learn this better. Bought from you.
Well, okay, sorry, bought from me. Okay, so here we go. So number 2, we have the ECB and Bank of Canada rate announcements. Is there something you're watching in terms of the outcome?
I am watching the ECB. I'm looking for signs that they understand that more negative rates are going to hurt their economy. I got this little thing, Patrick, where I actually think that maybe later in the year we could see a situation where the ECB is actually raising rates. I know that's crazy.
Oh,
but that's I don't know. I don't know why I got this feeling.
What did they put into your beer?
I don't know. I think that they're waking up to the fact that negative rates are bad, and we'll see. And maybe I'm just talking my own book.
So you think that like the 10-year German yield is going to go positive here?
I don't think 10-year.
Well, then you're talking inversion.
No, I just.
Well, if they go positive,
Patrick, I just think that we're going to see the story is going to change in the coming quarters, where the ECB is no longer going to be threatening lower rates, and that they even might start threatening higher rates. And that's, I don't know. Maybe I'm talking about a book. I'm probably early.
No, but you know what? Technically. I mean, we've seen that they have not been able to sustain lower. I guess minus 75 basis points or whatever. What was the low? Like minus 90 basis points. But this has certainly looked like it's reversed. And so yields pressing towards 0% on the 10-year German yield is entirely possible. I mean, I wouldn't be a seller on that idea.
Anyways, just watch for it. That's what I'm saying. In terms of Bank of Canada, who knows? Our economy stinks. We just went into lockdown here in Ontario. It's going to be tough. I'm sure in the meantime, our housing market will continue to levitate higher. And so,
because it makes sense.
Probably bullish it's bullish for housing, probably.
Yeah, I'm sure it is.
Yeah.
All right. So number 1 was one that you were going to opine into as whether the bond bear market is over or not. And obviously, we had a bit of a move in yields. But what's your thinking here?
So, Patrick, there's no way the bond bear market is over. But having said that, I think that we're going to have the corrections. The correction in the bear market is not done, and we're going to have a continued lowering of yields.
So where do you think?
I feel dirty being long.
Yeah, I was about to say this is not the Kevin Muir I know. This is
traders got to trade.
Well, you know what? I don't know. You know, I'll tell you. Like if commodities were to peak out, then I'd say I think it's all intercorrelated, and I just don't see yields taking a big step lower unless the entire reflation trade right across the board paused. I'm not trying to say
really?
that.
So what do you mean big step?
Like I think right now, like if oil goes and breaks towards $70 and you have commodities rallying, I think inflation expectations may stay hot under those circumstances. Can the 10-year yield shave off 25 basis points lower? I don't think so.
So 25. So you're talking about
like I'm saying, like if we go back to like 130, 140, like I don't think so.
Oh,
maybe we have a bet. Maybe we have a bet on this later on.
Maybe we do.
I'll let you make the bet on that because anyway, we'll talk about it when we get there. All right, so let's talk some charts. I just put together a hodgepodge of different charts that I want to cover, and we're just going to go all over the map here with no theme. Let's just start firing these off. First of all, obviously, gold put together two solid up days, but we're approaching what I think is going to be a pretty critical level as we approach about this 1800 mark. And so while it's certainly been a great 1-2 week long rally in gold off of its lows, I'm still just a little bit cautious. I think that if the bulls don't follow through here on this and we find ourselves back below 1750, that there's still room that this is still in consolidation. Anyway, I'm watching that. You're pretty bullish at this moment?
Oh yeah. I think you're selling.
Well, I mean,
short.
with your view on yields, that's clearly the case. What I was gonna just touch on here, like look at this transports index. Right, this is the ETF on it, but the transport stocks have just been on fire since February. Just what a run! Who would have thought rails and other things like this would have been doing so well? But just a great move, and there hasn't been even a proper pause or correction at all along this way. How long are these transports going to be able to keep going like this? Certainly, I don't see much asymmetry in chasing them. I mean, at this stage, you're trading pure momentum, and even then, the last kind of week or so, it's been a pause in that momentum push. I don't know. It's I'm just not enthused about this. It seems like the easy money is all rearview mirror on this.
And we thought the same thing about lumber, though, and it continued going higher.
Well. Anyway, the VIX. Look at man man, did the market gods really school you on that one?
Oh, so bad, isn't it? I lost a stake on that. It was the only time it was above 20 for
Not
the
just
last
any
3
stake, a
weeks.
wagyu, my friend.
Wagyu. It's okay. We're never going to be able to actually do it because we're not going to be able to get together because Ontario is going to be under lockdown forever.
Yeah.
What was the date? I'm just trying to see like the one.
Oh,
day.
I think it was this pop right over here. This close right in here, this 22. Like it was just like it was toying below 20 for most of the week, and then just closed above. I won the bet, and then it just kept bleeding. But now here's the question: do you think we could go back to that low vol regime of going back towards 10-12 on the downside? I'm a seller on that. I think that even though you were dead right about the fact that volatility could break that key support and we can go down here, I just don't think we're going all the way back down to those pre-COVID kind of conditions. You think that we can do the market can do that?
I'm scared to say this, but I agree with you. Which means we're about to melt up and just have a quiet head higher. Yeah, no, I don't agree. I mean, sorry, I don't think we can do that, Patrick. I think that VIX, you should be buying volatility down here, I think, somewhere.
Well, the S&P 500 has obviously been tearing higher, and it's been the hottest market. But one of the things I wanted to talk about is just how the Russell has lagged. These small cap stocks, you would think that in this type of a market environment with this kind of momentum, that at least you'd get some sort of participation. But like really, for the last 2 weeks, the Russell's been almost dead flat.
It's been a huge shift, Patrick, out of the old reopening trade, which was sell bonds, buy small cap, buy value. And what this has been over the last week is buy bonds, sell small cap, sell value, and go back to buying the tech, those big 7 names. And that's what's been happening. And I don't know if it's actually as positive as it might seem when you just look at the headlines.
Yeah. Yeah. So anyway, we're going to go all over the map here. So next one I wanted to talk is palladium. And out of the kind of precious metals basket, here's the one
that's a great looking chart.
Yeah. I mean, like we could see this gunning for 3,000 on the upside. Like this is by far the strongest of them, right? Like platinum has been stuck a little bit. It's still not doing bad, but like silver's turned up. But palladium, this is the place. Like it's going.
That's like a 1963 Corvette Stingray looking chart. Seriously, that's a good looking chart.
It's a good looking chart.
I'm gonna go. I wish you.
Are you
told
gonna
me
go put
that
some on your book?
Yeah, I wish you told me that before.
So you could front run.
Well, not that we're gonna move palladium, but no, that's a good looking chart.
Right, but the other thing, like I was looking at the grains, right, and wheat and the beans have been pulling back, but corn just doesn't want to quit, right? Like it just broke the other week to a fresh 52-week high, and just keeps crawling higher. And like maybe we should get Angie back on the show to kind of size up this grains market. But
well, the trouble about getting anybody that actually knows anything about grains, they're always too bearish because they've seen the past 20 years of it going lower and lower and lower. So it's like the Don Cox line, those who know it best love it least because they've been burned the worst. And I think that one of the things that you need to remember when you're looking at these, it might seem like these prices are way up. Adjust those for inflation and go back and look at what they are. They're still dirt cheap.
Sure.
And
sure.
not only that, fiat's going to zero, right? So therefore you got to buy real assets.
Because corn, yeah. Just load up the garage with corn. Yeah. That's a great idea. All right, so thanks for sharing that, Kev. I'm sure all our listeners appreciate that. But the other space that's been quite the laggard outside of the Russell has been the emerging markets. They also have not only had that correction on the downside off March highs, but they just can't catch any tailwind whatsoever to get off of that consolidation low. The thing here, obviously things like the dollar and commodities are going to play a part in this because they all have an influence. But it'll be really interesting to see whether what happens next on the dollar index influences this next trend move. It certainly has emerging markets. It feels like it's early stages for a new breakout if we have a dollar breakdown. What's your take on the emerging markets?
The submerging markets?
Yeah.
The thing about the emerging markets is that there's more and more China in it every year, right? So that's one of the things that's holding it back. And then when you think about the other things like Brazil, it's a disaster down there. It's a humanitarian, nightmare. It's tough to get excited about the rest of the world right now. It's really, apart from the UK, the US, and Israel, everyone else is suffering from, losing the battle the race between vaccine and the virus. And so to me, I don't know.
Please stop making connections between COVID numbers and the stock market. It's like the worst market timing tool ever.
I'm not trying to say that it's that you should use it as market timing. I'm just like, it's tough to get excited about emerging markets when their economy is suffering from it, though, Patrick. There is something called fundamentals.
Yeah, but that's when the shit is cheap.
Yeah, but it's not, though. My point is that it's not. And it's not like the things have been going down. They're just not going anywhere. Anyways, I don't know. Maybe I'm wrong. You're probably right.
Just buy Facebook. You'll be all right. All right, so let's talk the copper miners here. And so this is the COPEX thing, and it's like copper has been doing very well, but the copper miners are attempting to break to that 52-week high, and it's going to be really interesting watching.
I think the copper miners look a lot better than the actual copper, the underlying metal.
I wouldn't say so. Like copper has worked nicely off of. Let me just pull up the chart here on copper. I mean,
I'll bet you if you do a relative strength that.
No, but I'm just saying. Like, look, how far is copper from a 52-week high? Yeah. It's not much different. I mean, yeah, those basic material stocks have done very well.
Are you long these things again?
Yeah. Okay.
I sold my copper and I actually feel a little naked without it. I'm
put some skin in the game. Just buy some gamma on the upside or something. Just put a bull call spread or something.
Patrick long some options. That's a surprise.
Yeah. So the The other one I wanted to touch on is this aerospace and defense. Now, we talked Boeing, which is a component of this stuff, but this has been continuing to plug along, and it's at a major overhead resistance along those previous highs. And one of the things I'm going to be really watching this week is whether we finally get this breakout. I mean, we've seen turns on a number of the components that have been lagging, like the LMT and the NOC and all of these other ones, but Raytheon's been doing very well. It'll be really interesting to see whether this can kind of break out to a fresh 52-week high. If it does, I mean, maybe we'll see 110 to 115 on the upside of this. Another sector that's been is winding up is this metals and mining, which obviously the copper stocks have some play in this, but this entire space is working back up to 52-week highs, making higher highs. Trend lines are staying intact. It'll be really interesting to see whether 52-week highs come in this entire space.
I have a question for you, Patrick. You're pointing out some things that are potentially breaking out to new highs. Have you found that over the last 6 months, or maybe even 9 months, that technical signals on breakouts are more reliable? Because I sure have. It's almost like more people are watching it, and it's more when you get those moves. It used to be you'd get a lot more prairie dogs, but it's like there's been a hunter out shooting all the prairie dogs.
Well, I mean, listen,
I guess it's a function. It might be a function of the bull market. Like
since
obviously.
November, when that entire move started, there's been certain sectors that have just been in relentless trend, and buying every little dip and turnaround, every breakout has just been what's working. There'll be a point where it'll stop working. Just once you're completely convinced that it's working, then you got to keep doing it.
Well, that's probably
when it'll
so
stop.
I probably just did it.
You probably did it. So everyone now, all our listeners know, stop doing it.
Yeah, but would you agree that breakouts?
Oh, that's been the case. Oh, yeah. It's been the case.
They've really run. Like you just go, you're like, what the hell? Why is this thing up? And it's just because it broke out.
Yeah,
and it goes, and it's like there's more and more.
But chasing what's working in momentum has been there's more and more concentration of that. That's I think a trend of everyone being hooked on easy money, and so you chase what works, right? It's something that's got a positive feedback mechanism to it. Anyway, the one though that is interesting is this rare earths. Not so rare rare
I
earths,
won't make
right?
my joke, but you love the rare earths.
I just did it for you. I just did it for you, right? Like it.
What's the symbol on this thing? You're like the only guy who trades it. REMX. Let's have a look at the rare earth. Are you like 50% of the volume on this thing when you trade?
Probably.
Probably 50% of the options.
It got murdered obviously in March, and it feels very much like the charts on like the emerging markets or small caps, right? Like
it does. It looks almost exactly like emerging markets.
Yeah, it does. So that's probably going to have some sort of I think you want to watch whether that gets some momentum. Now let's talk another darling, the uranium.
God, that's a terrible looking chart.
It's starting to get very heavy. And you know what?
What is this that we're looking at? Is this?
This is the this is a uranium mining ETF. So this is just a basket of all of those uranium stocks. And so it's an ETF basket, but you can really see that the easy money momentum trade of uranium off of those lows back in November, December that really broke out, that's now running into some active distribution up here. It doesn't mean that there has to be some really ugly drop, but it certainly feels like the easy money is all rearview mirror on this, and it's going to be a muddle here for a little while.
I'm going to take the other side. That thing's, even though it's a terrible looking chart, I feel like it's not going to work on this.
So if it goes higher, you'll buy, and if it goes lower, you'll sell.
I'd be buying it here, even though it looks terrible.
All right, there you go. That's conviction. We'll see. I wanted to draw the one trend line on the gold miners, and one thing I want to watch is do the bulls hold this breakout? You know what? You were just talking about that breakouts have been working. So is this breakout going to stick? I think we need a drum roll and maybe a week of price action. We should come and revisit this next week, right?
That is just an absolutely beautiful looking chart. No, honestly, that's like a 1967 911 S coupe. Like that thing is just gorgeous. I'm telling you, like I probably Gucci'd it, but I love this.
You already did. Stop talking.
I love the miners here, the gold miners here. They're awesome.
All right, so what I wanted to touch on is Canadian banks. We don't talk about them enough, but man,
because the rest of Canada is talking about them so often.
It's not just that they're talking about them more often. It's about the composition of every Canadian's portfolio.
Right. It's like you can bitch about them, but it's okay because the reality is that half your portfolio is full of banks.
Yeah. So, but what a run they've had, but they have not even paused. Like it's just like a dead crawl higher every single day. Like I'm getting nervous about this. Like things shouldn't go up every day like this without some sort of a pause or mean reverting correction. Something doesn't seem right about this. I don't know. It's what a run though. Hey, listen, anyone who's got these Canadian bank stocks, they got a big smile on their face right now. That's for sure.
Which is all Canada, but the reality is that we're all like locked in our homes.
Well, yeah. Now they're rolling it all into real estate because all the multi-generational highs in real estate prices. It makes sense, right?
Right. But Patrick.
Yeah.
Did you see? You're talking about how something shouldn't go up this long and this often. Did you see that the SPY ETF broke a record this week?
No.
The SPY. Well, obviously you don't read my letter, which is very clear again.
Well, I just haven't gone to. It's been a busy trading
the weekend. 13 days in a row, the SPY closed above the opening. Like so, there was a green bar, a green candle, and I'm wondering if today is 14. Did it do one more day today?
Yeah, it did.
Are you sure?
Well, there was a red candle here. Are you sure you did this right?
Yeah.
What about this day over here?
Oh no, count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Oh, that was the 13th or whatever. I can't.
Yeah,
then we missed the green one at the bottom. So actually, so they'd already got ruined. I didn't realize that.
Yeah. Yeah. So you got to go rewrite your piece.
No, I already wrote it. This was way from Wednesday or whatever. Which, of course, then I got the red bar right after that. But listen, that looks like a cross up there that's just hanging up in the air.
That's called a doji candle.
Is it like that's not good looking? Like that's
ominous. You know what? I hate when people overread doji candles. So it's just whatever. It's a whatever day. It's like in the end they neither could take it higher or lower. Sometimes they form at tops, and then all technicians get all excited about it. But you need a sell day on the other side. The one thing that I was talking about on a couple of charts is just the magnitude of the rise the S&P has made off of its 50-day moving average. We are now at levels that only the rallies back in the summer of 2020, where we had this type of separation from the average, which just basically means the market is pretty overextended on the upside. It'll be interesting to see whether the bulls can make it stick. But let's talk. You want to make one more comment?
No. You got a lot. You got a lot of symbols there. Still, we got to get through. I got to stop interrupting.
No, you don't have to stop interrupting. But let's talk some cannabis. This is the
we all needed us. Like I don't understand why all these prices are going down because they just locked all the Canadians in their homes for the next.
Like that's like weeks. The most cannabis bullish of news that you could possibly get, right? But it just doesn't want to get off the mat. It's ever since that blow off high back in February. It's just been a relentless bleed. And it'll be really interesting to see how long this could this be another bubble top where this thing just bleeds for months and months and months.
You know that top was stupid. Wasn't that all Tilray? I think it was. Tilray went from let's just look here.
It was stupid. Yeah.
Tilray on the did that coincide with the February 10th?
Yeah, that was was that the Wall Street bets thing?
So let me just look. Let's see how much Tilray this the HMJs, is that what it is you're looking at?
Yeah, HMMJ.
Yeah, okay. Let's just look here. Afria, which is basically Tilray, is it's 14%, but then Canopy Growth, maybe I'm wrong. Tilray is there at 7%. So 21% of it is Afria and Tilray, which went together.
Yeah.
I don't know, Patrick. I don't have a view really. These things are generally wealth destroyers.
Anyway, I just I would have thought that with this type of market price action, that these things could have at least had some sort of positive reaction. Like even even like the small caps have been able to get off the mat. It's not impressive what they've done, but they at least are off of their lows. And it just seems like every day these stocks are hit with a new round of selling.
They're overvalued, man. Weed is it's a weed.
Yeah, it's commodities.
Yeah.
It's anyway. So the one other interesting thing was that this is the minimum volatility factor ETF. Just it holds all the McDonald's of the world, and just really shows that those consumer staples and those kind of baskets, those stocks in that basket, have just been on fire. This is what's been driving the S&P, right? Like I know the Nasdaq, and we talked FANG stocks and stuff, but like these stocks have. This is why there's a big difference between the S&P 500's move, the Nasdaq's move, and the Russell. Like I think that all of these minimal or low volatility names have actually been the driver behind the S&P's move.
So I just pulled up what's in this thing. Guess what the number one holding is?
Well, if it's market cap weighted, then it's going to be what, like Microsoft or something?
It is. Well done. Number 2 is a weird one though. Waste Management. And then Accenture, Johnson & Johnson, McDonald's, Visa, NextEra Energy, T-Mobile, Newmont. There you go, big guy. Vertex, Gilead, Eli Lilly, PepsiCo. Anyways, yeah.
Yeah, it's like low vol names, at least relative, right? And so anyway, let's talk ARK.
Oh. Does everyone want to be short this? Do you know anyone that's not like, foaming at the mouth to be short?
Yeah, that is the problem. I want to be short this, but the problem is everyone agrees with me. It makes me nervous.
For sure, you should be petrified.
And it says the guy who's short Tesla.
Yeah,
like I mean that's like it's a 10% weighting in this thing. As goes ARK, goes Tesla. So you're like, I would never short ARK, but I'm short a whack.
Listen, I have no problem shorting ARK. If you want to short ARK, then knock yourselves out. Like I have no problems. Like I understand it.
But the point is that, like, okay, the Nasdaq made a 52-week high, right? Like, so the FANGs started ripping, and it's the ARK basket that's not participating.
Well, because she owns all these crazy like SPAC crap. It's like really,
but also a lot of the components. Like, I mean, let's be realistic. Tesla's price action has not been impressive.
Well,
like I mean, well, it is
too impressive for me. But like you're obviously not short enough. Okay, let's look at this ARK though. I just want to be curious about what the borrow situation is. I'm pulling it up here. See, you can still borrow this thing for cheap, which kind of leads me to believe I'm not right about how many people want to be short.
Yeah.
I don't know. It just feels to me that I like everyone tells me, oh, I'm short this is going to be end in tears and stuff. And I'm like, geez, I don't know. It feels like there's better things to short.
I like the idea of shorting it, but
you?
I am not short ARK, but I certainly am toying with the idea. The other one I want to touch on is the one that you've been extraordinarily. I want to give you kudos on the home builders.
Oh, thank you.
Because you know what, I was just not convinced. Like you were talking home builders all the way from the May of last year. Like you were basically home builders this, home builders that. I'm like, maybe, but I wasn't thinking. But this has been one of the best performing spaces that actually has real fundamentals.
Patrick, I really appreciate that. That's very kind of you. Now I'm going to have to go because I have to go place some sell orders.
But did you see the run on Home Depot? Like it's in there. Like look at this move in the last month.
Yeah. Listen,
or
there's
like
a lot of
Lowe's
people with a lot of money in their jeans that want to do stuff. You can't build houses quickly enough. Lumber is another one. It's just. I think the mistake though on this is that everyone's thinking that it's just a cyclical story. Yeah. And I really do believe that it's a secular story. The American millennial never bought houses. Here in Canada,
not Canadian enough. Yeah.
Yeah. Well, here in Canada or in Australia or Well, they don't buy places in Germany, but in a lot of other places, the millennials, were extended credit, and they went and they bought it, and they got long real estate, but not in America because they'd seen their parents get absolutely devastated in the 2008 great financial crisis, and so they've been basically renting and living in their parents' basement, and the reality is that eventually they're going to grow up and they're going to start a family, and then they have to buy a house. And it's just, I think it's still, even though it's up a long way, Patrick, I think it's got more to run. It's a secular story that's going to last for a long time.
There you go. Listen, I like your idea, but I don't think that necessarily has to manifest with continued rising in the home builders. There's a point where that's going to already
You're right.
be baked
It doesn't just because there's more housing that gets built doesn't mean that the stocks go up. You're absolutely right.
These stocks have already priced in some pretty darn good bullish outcomes.
Darn good.
Right?
Yep. Okay.
Darn good.
Yeah.
So the next thing I want to touch on, doesn't this social media ETF look like the ARC chart?
It does. And is that the one that's the
SOCL? That's global. So it's got it doesn't have just the US.
Isn't that Chamath runs that one? Am I wrong? No, I think I might be wrong.
Yeah,
he's got something else there that social media.
But this is the social media basket. But it's interesting. Again, the Nasdaq made 52-week highs. The semiconductors are up there. Like you're getting a lot of these FANG stocks that are pushing. But
I know why this is bad. This has got a bunch of Chinese names in it.
Yeah, that's contributing to it for sure. But the point is it's like you see that in the tech space, you have to be very selective, right?
It is, but it's the top 7. That's the ones that are doing well, Patrick. You just have to go spy and then look at the top 7, and those are the names. Like look,
right,
it's
like
Apple,
Google,
Microsoft, Amazon,
Google.
Facebook, the 2 Googs, and Tesla.
But Amazon has gone back to its highs. This is not like
no, it's not
like your leadership.
But don't forget, that's a big stock, though.
Yeah, but Microsoft has moved. There's been a nice move on Microsoft, Apple. But even Apple, it's not like 52-week highs. It bounced. It looks like the Tesla chart.
But then you put it with No, listen, Apple's better looking than Tesla. Tesla looks more broken than that. Don't you think?
Oh, come on.
Pull it up.
Look, it's the same shit.
No, it's much lower, though.
No, it's the same shit. I'm not going to say one is better or worse. All I'm just saying is that if you're trying to tell me that this entire rally's been on the back of like the Apples, I'm a seller on your
No, but
statement.
Pull up the Googles.
Yeah, Google is, but that's not.
Google,
you just
Microsoft.
Said the top 7.
I said the top 7, but they haven't hurt
Apple
you,
hasn't.
and they've rallied, and then you've had the ones that explode.
No.
Anyways, that's what makes a market.
Anyway, it's certainly an interesting market. That's
Wait, you got
that's
one last one. You were going to do XLK.
Well, that was all I just wanted to. That was just looking like that's another version of the Qs. I was just like talking about how the fact that the technology has been doing really well, while the social medias and ARCs have not participated. Is the only point I really wanted to make there on that. All right, but that's it, bud. That's all I had to cover today.
It was good. I liked it. I liked the hodgepodge.
There you go.
Okay, Patrick, it's time for This Week in Trading History. What do you have planned?
Okay, so this week we're just going to do a throwback here, and it's more reminiscing than anything else. We talked a month ago about the bubble peak of 2000, but this day in market history on April 14th of 2000 was a day where the Nasdaq plunged 355 points. It was about a 10% down day. But more importantly, it was the moment where after 21 days of selling that the NASDAQ was down 35%. Now, when you look at that chart and you look at how bad the bear market was in the period, it doesn't look that significant. But isn't it crazy when you put it in the context that during the COVID crash, that a horrific event, that was a 33% drop in like 30 days. Like this first leg down on the NASDAQ was had so much velocity that it put the COVID crash into shame.
That's a great point. I never thought about that.
right? Like,
Yeah.
and it was significant. Now, marked a multi-week low. The market continued to stay weak for a little bit for another month before a more meaningful bounce. But that first drop, it was just one nasty drop. And the interesting part is the way that this played out was where I sort of, I anchored too hard on this this analog for what I thought was going to happen in the post-COVID period, and the bull market just kept raging higher. But I really thought that there was a chance that there was going to be more selling, and I was wrong. Like that was
It's just because
I'm
you were
too
hanging
bearish.
out that other guy that you do a podcast with too much.
No, I'm just too bearish. It's I'm the Canadian bear. There was someone on Twitter who keeps joking about that or something. Anyway, but one way or another, it was the beginning, though, of a systematic bleed-off that lasted 3 years. That saw the NASDAQ lose over 80% of its value. But it was interesting, some just little tidbits of information, right? Like there was no real pin that pricked this bubble, at least not that I'm aware of. But what was noteworthy was what the Fed did was far different in this cycle than what was going on today, right? Because we were, at the time, there were 3 rate hikes in 99 and another 2 more in 2000 before the thing. So arguably the Fed was doing sufficient tightening to finally take the air out of the sails of this thing, and it fell under its own momentum. And so it goes to show that, it's going to be important to see when Powell finally shifts monetary policy, if he does at all ever, right? Like, but it really, I think it was instrumental. Do you think that that's going to be a big turning point eventually?
For sure.
When Fed
I think
changes?
that everyone sits around talking about all sorts of fundamentals, and they don't realize liquidity means way more than anyone anticipates. And you're absolutely right that the reason it kept going down was the Fed kept tightening until they got to the point where they said, "Oh, we're actually affecting the real economy. We better stop."
Yeah, some interesting other little tidbits of that period. So, like in '99, that we see that today, but in '99, one hallmark of a successful company was its ability to prolifically lose lots of money.
Oh,
as far as that was like the core thing. Like if like an example, like remember Priceline. Priceline, their goal was to lose the maximum amount of money, and there were its competitors like Cheap Tickets were said, we simply can't. It hurts our valuation because we're actually trying to make money.
Yeah, no, you got punished if you tried to make money, because everyone thought it was such a great opportunity that the reality was if you weren't spending, you weren't grabbing share. It's very reminiscent of many different facets of the same period. I completely agree, Patrick.
And another really interesting thing that led up prior to the turn in the NASDAQ back then, there was a substantial pickup in insider selling. So there was a situation where the insiders started selling almost at a double the rate that they did in 97, 98. And it was to the point that they were selling 23 times as many shares as they were buying. And what's interesting is there were some recent headlines of insider selling, but right now, but in this froth, it was interesting back then that insiders were like, this is stupid. We're just going to start dumping our own stock, and it'll be really interesting if we see that start to develop in today's market conditions.
But did they actually sell? You're saying that the inside, because I think back to that time.
Well, they at the time compared to 97, 98, the insider selling doubled from those years. So
it wasn't like they sold it though. They
No, but the ratio of sells to buys was 23-1.
Okay,
right. So they just weren't buying.
Because to me,
anyway,
it feels like Mark Cuban was the only guy who actually got out by selling and getting cash. Right? He was smart enough to say, no, I don't want stock, because a bunch of the other ones were so greedy that they demanded stock.
Yeah,
and geez, that doesn't sound familiar about anything like in our current environment.
No, it does
No.
not at all. No, but anyway, that is history. I just want to point out that the rapid decline of the Nasdaq was even more severe at the start of that crash than the COVID crash, which felt like it was the worst event that ever happened. And clearly, there are much worse circumstances that happened in the past.
That's a great little tidbit, Patrick. Thank you for sharing that with us.
All right, bud.
Okay, time for skin in the game.
So
I lost another one, right?
You lost again, and you fell on your own sword. I was, of course, the problem is I agreed with you. You offered me a steak.
I know.
And,
Why don't you tell people what the bet was, first of all, and then.
All right, so we simply bet the over/under. At the time, there was huge open interest at the 4,100 strike on the S&P.
Oh, that's right.
There was gonna.
Everyone was talking about the Magna pull to 4,100. Which I knew should have been like a huge warning sign that everyone was talking about it.
But the low vol kind of gave it the van a tailwind. Anyway, whatever. The point is that the problem was that I sort of agreed with you, and so I didn't have the conviction to take you up on your stake
Right. So I let you
trade.
choose under, over, and under. You chose.
No.
Or did I choose?
I made the bet.
Oh, that's right.
You
I got to
picked
choose.
under.
I chose under because I was bearish. Trouble
And then
was you were bearish too.
And then you said, I'll bet you a steak. And I basically said no.
So
and I made it a burger bet.
You could have had 2 Wagyus.
I know. But it's
okay. We're never going to be able to actually do these things. We're going to be under lockdown for the rest of our lives.
All right. But anyway, so I won this one. So why don't you tell everyone quickly the little bit about what we're doing, and now let me make you a bet.
Okay. You got one ready?
Yeah.
Because I don't have the script ready here.
All right, no, but the point is that we're going to bet some.
Just kidding. Here we go. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency is, everyone knows it. It's what is it? The meat of dead animals and beer. The winner of the bet is obligated.
Alcohol.
Sorry.
Because there's wine in the.
Oh, that's right. The winner of the bet is obligated to create a new bet for the following week, which is going to be Patrick. All wagers settle in full, and there will be no netting in positions. We're not animals. Okay.
We refuse. This is there. We all physical delivery on all bets.
That's right.
There's no such thing as netting out of bets.
Okay. So what do you got for me?
It would just.
You're going to do bonds, aren't you? I know you are.
No, I'm going straight to biotech. I just completely disagree with you.
Okay.
And I'm just going to make this super easy.
Oh, you're going to do up or down from here?
Up or down? Yes, straight up. Up or
And
down.
so
is
is
it
it
closed?
the XBI?
Right now, it's the IBB, which is the
I'm
biotech
taking down.
ETF.
You're done.
Yeah, down. I'm taking up.
Okay. How much you want to do?
Well, you're the one who can start the betting. You're the one who
I'll tell you what. I'll do it again. All the way up to steak dinner, you choose.
Done. Forget it. We're doing it.
Steak dinner?
You know what? Like, no, because you're gonna keep like making me look like a fool that I'm like no. You know what? Listen, you're willing to go to
fine.
steak. I'm willing to go to steak.
Okay, that's fine.
it.
Good for you. Don't take my shit. I like it.
It's it. Like I
like it.
I got to draw the line
Yeah,
where
that's right. You can't let me talk. Push you around like that. You're absolutely right.
Exactly.
Yeah, no,
forget it. The line is drawn over under. So just to be clear, the IBB is trading at $153.26 on the close.
Okay.
We're simply doing an over under. You're taking under. I'm taking over.
I wonder how much I'm going to need to move that thing around.
Yeah, you're gonna have to whip some. I'm gonna just buy out of the money call
You're gonna
options
go
for
and
weeklies. And I'm gonna gamma it up. Yeah, I'm gonna squeeze it out so that.
Okay, well we're on, buddy. I like it.
All right.
I'm gonna lose when it really matters, which is dumb. So you're right. Good call, buddy. That's well done.
Let's see what happens. All right. It's time for No Stupid Questions, and this is where Lena gets to hop on and pitch some of these things. So let's, Lena, how you doing?
I'm good. I finished beer, so we'll talk about that at the end of the show. But
Lena's
I'm feeling
like,
pretty good.
You're slurring.
She's like, I like the beer.
I like the beer, but we'll talk about that later. All right, so the first question for this week. My question is about rolling options. If we own in-the-money options as we approach expiration, when should we roll if we wish to? A week out, the day of, what should we look at when making this decision? Follow up on that. Do you guys have any wisdom on when to roll and when to exercise?
This one's all you, Patrick.
Okay. Okay, so the bigger question, like if the question was about at the money options, that's a little different. But once you're in the money on an option, even the week before, sometimes there's almost no time value left in the option, and there's always the risk that there might be an assignment or exercise depending on whether you're short or long, obviously. But generally, when you're in the money and there's very little time value, to me, it's more about my bigger view of what I expect. So if I expect a stock to keep moving, or I think that something is about to happen, I often want to take an action based upon my bigger theme rather than about whether the option is at a particular moment. I mean, when you're in the money and it's a week before, there's virtually no time value. It's only if it's at the money, and let's say you're short options, you might want to just take that theta burn right up to the last day of expiry. But generally, I think it's much more about the theme of the trade than it is about the nuance of the option pricing. You have anything to add to that?
No, it's so good. Okay, Lino,
there you go.
On to number 2.
My God, this is long. This is a book.
Yeah,
This is a book.
long one.
Go for it.
All right. Hey, this question comes from the Emerald Isle, Ireland. I'm a big fan of the show. It's great learning and entertainment from a couple of wise, humble, degenerate gamblers like myself.
Of course he's a degenerate gambler. He's from Ireland. Greatest people in the world. I've always said if I have to stuck anywhere.
Your favorite types of people.
I love people from Ireland. Just love it. And just I like their beer. I love them. I love their humor, their self-deprecation. I just think they're the greatest people ever.
Are you done?
I am.
Are
done.
you done?
I love them.
Okay.
I went on this UK trip, and all the snooty people told me not to go to Ireland. Like all the snooty people from England, and I went, and I loved it. It was my favorite part of my trip.
There you
Anyways,
go.
I just love them. And now,
all right.
I was
Can
lucky.
we go on with the question?
Lucky,
It's already...
1 second. I was lucky because it actually was like the 1 week or the nicest week in like 20 years that I was there, and it didn't rain a single day, and so I didn't have the bad weather. So I might be a little biased.
I think we're in the post game already, Lena. Like this is.
Lena. I'm sorry to interrupt.
This is a long one, so let me continue. I have a hypothesis on gold, and I'd love to hear you guys provide a contrarian view on my planned trade. The U.S. 10-year Treasury rate has been rising fast since August 2020 and seems to be currently trading in a range of 1.6 to 1.75%. As the saying goes, rising real yields are kryptonite for gold as it earns no yield, and gold has been dropping since August 2020. U.S. dollar strength has also hurt gold in the last few months. Market equity indexes QQQ and SPY puked in October 2018 when the 10-year hit 3%. Given an increasing corporate debt burden as a result of COVID-19, various analysts are predicting another market puke at a 10-year rate of less than 3%, maybe 2 to 2.5%, as quote-unquote zombie companies struggle to pay interest on loans with increasing rates. I'm betting that when the market pukes again, the Fed jumps in with yield curve control. Gosh, I can't read properly today. Driving the 10-year rate lower. And of course, they will employ more fiscal cannons. This, coupled with possible inflation, means real yields could move materially negative. There is also a chance that this drive down the value of the U.S. dollar. Were this scenario to unfold, we have the holy trinity of 1, a falling or capped 10-year rate, 2, a weakening dollar, and 3, inflation all pushing gold higher. This is nirvana for gold, especially the miners, as they seem to increase and decrease around 3 times the gold spot in percentage terms in bull and bear markets. So my trade is to wait in the long grass till the market pukes, then buy all in, currently in cash, on gold miners. In the spirit of being a degenerate gambler, sit back and enjoy the spoils. I appreciate I may need to wait some time for this trade, but probably less than 12 months. And whilst I do plan to go all in, I will add stop losses to avoid material loss in case I'm wrong. That's the wise part of the degenerate gambler in me. I'm a retail trader. It's my own money, and I'm not under the gun to make money fast. I appreciate you must get hundreds of emails, but would love to hear from you on if and why this is a stupid trade.
Kev, go ahead.
Well, okay, so my big problem about this is like he's right. Although I guess we're not sure it's a he. The listener is right that is gold nirvana. Like what they sketched out, the holy trinity. I like it, But like, I don't know if you're going to get the Holy Trinity that you want. Personally, I don't think yield curve control is ever coming. And if it does, it's going to come from a much higher rate than 2.25, 2.5 on the 10-year. And so my only pushback to this little gold, bull's wet dream is that it might not happen. And so if you're prepared to live with, gold potentially going up and you not being involved, that's great. No problem. And I get it. But I will completely agree that if your scenario comes to be that this is the point to throw all the chips in. I don't know. That's my 2 cents. What do you think, Patrick?
I've learned not to spend too much time on the sideline. I think that the gold pullback's been enough that you should already have some skin in the game. But the thing is it's like, how do you hedge it and how do you manage through a cycle? If it does get better, like how do you take advantage of that? I just think that when you're just sitting on the sideline waiting for a particular scenario, if it doesn't materialize, it's hard to get skin in the game at that moment. Like, do you redraw the narrative? It's sometimes waiting for this perfect scenario might not happen.
Yeah, I think you know somebody that's like that always waiting for something for the trade to get into a trade. I don't know.
No, I would have never known anyone like that.
Anyways, Lena, number 2.
Oh, that was number 2.
Number 3. I'm sorry, I can't count. It's not like I use numbers for a living or anything.
So question number 3. Kev, what's your estimate on timing for this huddle piss up? Also, is there a dress code? If I have to wear a candy cane dress shirt like Patrick, I am not coming.
You guys had to put the picture, right?
So now I got a couple of things to say. The timing is up in the air, and obviously Ontario just took a huge step back where we're under lockdown, so we're miles away from doing it. Realistically, I'm thinking that like winter's probably going to be realistically the best we can hope for, because we're going to get people coming from we already had people commit from coming from overseas, so we have to make sure that they're all allowed here and that they have to be able to come to Canada without having to quarantine. So at the very least, that's the first thing you should look for in terms of.
There is a modest variant to the main market huddle piss up that is going to occur in Miami.
Okay, 1 second, we'll get to that, because that's when you're cheating on me with again going off and doing other stuff without me. But I wanted to address the real issue here, which is the candy cane dress shirt. Now, I am the first guy, as you know, to make fun of Patrick. I think he looks kind of suave here. Like, I think he's looking good. Lena, what did you jump in there?
It's a nice shirt.
It's a nice shirt. I think he's looking nice.
Listen. If I have to wear something like that to the piss up, because otherwise the male female ratio would be completely out of whack. You have to wear something that
changes your
ratio. Gender?
What the hell is that?
Attract? No, it has to. You have to attract.
Oh, I'm sorry. I didn't realize that. You have to rise above because there's going to be so many males there. You have to.
Yeah, but you know.
You're going to peacock, is that?
Yeah, that's right.
Peacocking.
Okay, so when the piss up happens, everyone, Patrick is thrown down the gauntlet.
Everyone's got to wear a black t-shirt.
No, he's thrown down the gauntlet. He's going to peacock, and it's up to you if you want to peacock and try to out peacock him.
For those of you that are just listening, if you haven't signed up for our newsletter, please sign up at markethuddle.com, and you'll be able to get this beautiful picture of Patrick in his candy cane shirt.
I love that comment. The long and short of it is the piss up is still very much up in the air. The number one condition will be the fact that people will be able to come out of town without having to quarantine. And then now we can talk about the Miami piss up, which you shouldn't have called the piss up. You should have actually called it like something else. So why don't we come up with a different name for it? The Miami Muddle or something like that. Like you're gonna go do you're gonna go and do a list.
Yeah, that's not bad. A Miami Muddle.
Okay, there you go. So the Miami Muddle, you guys are gonna go, and so for anyone that's interested, do you have a date and everything now?
No. We'll announce it soon. Like when there's more clarity on everything, and when we have a place for it. Like we're going to give everyone at least a month's notice.
What is this conference that you're at? What is it?
It's the weekend of the June 11th to 13th. So it's definitely happening one day on that weekend.
What's going on then? What is it that you're doing?
George Gammon's got his like rebel capitalist conference down there, and Cuppy's down there and everything. And there's going to be
conference.
Yeah, and then there's
I don't get
there's going to be
invited
like
to
Jeff Snyder, or Brent. Yeah, you didn't get invited. I know.
It's because I'm not bearish enough.
No, exactly.
I don't know how they get Lynn on there. Lynn is actually the one, like not end of the world person that they get on there.
Milkshake man, Brent Johnson's going to come for a couple.
Of course he is. The world's ending. Brent's going to be there. I love Brent. I've never actually met him in person. I'm a little scared because I hear he's like 7 feet tall.
Oh, yeah, he is. I've had many beers with him. He's so good. He's one of my faves.
Anyway, so it's the June 11th, and it's going to Miami. And let me just look here. So what is it? The Rebel Capitalist Conference. And
listen, we're going to send out all the information when we know more.
Fair
information.
enough.
Anyways,
in June,
maybe we'll get George Gammon to come on to the show as a second guest and shoot the shit with us for a bit,
sure.
And let us know.
George is a good guy. His listeners are still spamming me about the asset that shall not be named, but otherwise we're good. Okay, Lena, go ahead.
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Okay.
All right.
Sorry, go ahead, Patrick.
That time. No, you do it.
I go do it? Okay, thanks for tuning in to the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. It's Lena manning the Twitter, the tweet deck or whatever it is. Give Lena a shout out. I actually love Lena's use of GIFs. She does an appropriate amount of Schitt's Creeks I see there. Very good Canadian, supporting Canada by using the Schitt's Creek. Anyways, you can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content, and smash the like button or whatever it is that the kids say. And please, if you could, rate us and review us on iTunes. It's a dumb game, but we know the difference, that it makes a difference to Apple's algorithms, and it helps us out immensely. Patrick, where can they find you?
You can find me at bigpicturetrading.com and on Twitter at Patrick Ceresna. Now, Kev, where can they find you and your amazing newsletter?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for sticking around. And now I screwed that up, but stick around for the after show. I did stick in twice. Okay, let's do the beer.
Yeah.
Oh.
Lena is going to go first since she's already it's gone.
I'm already slurring.
Yeah.
So I would give this. I would probably drink a 6-pack of this. I would give it a 9.3.
Whoa! What the?
Oh my goodness!
Are you?
Wow. Well, that's good for you, Lena. I take it you liked it, obviously, because it's gone so quick.
All right, where are you going, Kev?
You know what? It's an amateur move. I'm going 9 even.
Oh my God.
I loved it. I thought it was
That's
good.
pretty high for Kevin.
Yeah, I thought it was great. Like right from the start, it was great. I was scared shitless out of it. It's got this crazy looking, logo, and it feels like something the millennials will drink. That it's going to be just like way too hoppy and just bad, and it's awesome.
Just right.
This is a very simple way to define this beer. If you like Bud Light Lime, you like this beer.
There's
and you're going to
no
give it a
lime
9.
in this.
Oh, yes. You could taste the freaking lime in here.
Google this. Is there Gringo?
There's a hint of lime in this for sure. And if you don't like Bud Light Lime, then you're going to do what I'm doing and give it a 5.
Oh my God! Really?
It's
Yes.
not sour enough for Patrick.
No.
I
This
can't
is
believe this, Patrick.
This is just a light beer. This is a light beer. If I want light beer, I'm just going to get the cheaper version and get Coors Light.
Oh, I'm taking the other side of that trade. That's a poor take from Patrick.
No, it's not. This is as real of a score that I've ever given a beer. This is a 5.
We've
this
had
is a
worse
5.
beers than this before. What are you
No. This is This is pretty low for me.
It is low. I think that's about as low as Patrick goes.
I don't go much lower than that.
Like
I don't
I've never seen him go below 5.
It's drinkable in a sense that like so you can drink water too, right? Like it's
you're unbelievable, man. Like this is just so bad.
Being so mean.
Well, but it's such a good beer too. Like it's
no, it's not. It's not actually. It's not good.
Oh, God, light and malty. It says. I'm just trying to figure out if it's.
I have the hint of lime in there.
I don't know.
Sure.
Lena, do you think there's a hint of lime in there?
I didn't sense it. I feel like you're kind of making that assumption based on it's got
That's it. I am going.
I'm
I'm going right now to go buy Bud Light Lime, and I'm going to put it with this beer on 2 separate cups, unmarked, and I'm going to ask you to tell the difference between the two.
So much hate.
No, I'm just telling you guys.
It's bad. Like it's like he's something's happened. I think it's the lockdown. It just brought out the evilness in him.
Yeah. What's going on?
Okay, well,
that's my candy cane shirt. You guys are making fun of my candy cane shirt.
It is. It was all downhill from there. Well, anyways, I love it.
He's gonna have to wear even more offensive shirt to peacock around.
There you go.
Yeah, you definitely have to peacock. Go for it. Oh, wait, I might have found this.
Done.
Here it is. I'm trying to figure out. I found this out here. La Pachanga means party, lively celebration. Obviously, that's why Patrick doesn't like it. Yeah. Let's see. Hops. Yeast. It's not a very good, they don't have a very good little saying or whatever.
Yeah, I can't find any, ingredients.
Yeah.
So I don't know what's in it.
And
anyway.
It's like...
I don't want to really talk about this beer.
I know, you're sick. Okay, so let's talk about something else. I'm going to give you...
You watched Archer.
So I watched Archer, and all I could think about was this, I was not ready. You guys warned me that it was a little raunchy. You warned me, so I should have been ready. I still wasn't ready. Huh? I was like, what? The first episode, I was like, what? Did I hear that right?
Into it.
I was like, wait, I didn't hear that right. But what I love is Lucille is the woman there, the mom.
Oh, she's awesome.
Jessica Walter.
Yeah. Lucille from Arrested Development is there, and that's awesome.
Yeah.
And Lena says that she loves Pam. I got to admit, Pam's pretty funny.
She gets funnier.
She gets funnier.
And I kind of understand though why Patrick did it, because they are kind of bite-sized. You can just watch them for 20 minutes.
They're 20-minute hits, right? My attention span is exactly 15.
And not only that, they're
bored.
basically geared towards 15-year-old, 15-year-old
my
humor.
maturity level.
So that's the humor. And anyways, I like it. I wouldn't put it as high as Patrick put it. I'm kind of desperate for shows. So that's why I'm watching them. But all I want to say is that I just was not prepared for the raunchiness. I just wasn't ready. I just wasn't. And I was literally the first episode, I was it might have even been 2 minutes in. And I was like, what? Did I just
I'm the guy who's watched Austin Power movies 5 times.
Yeah, but that's not raunchy. That's just that's kind of funny. And that's
just silly funny.
Do you know what I saw, though? Speaking of Austin Powers, do you know that Austin Powers, what's the
Mike Myers?
Mike Myers is but who's the other guy that was in Saturday Night Live with him that when they did Wayne and Garth and or what is it?
What was his name?
Dana
Carvey. Do you know that Dana Carvey did an impression of Lorne Michaels, and he never did this publicly, and he did it behind the scenes. He did this impression of Lorne Michaels, and it was basically Dr. Evil. To the point where he even did the thing with the finger, the pinky. And the two of them...
Mike Myers got it from.
And Mike Myers stole it. And basically Dana Carvey was pissed for decades. And I saw an interview where he says I'm finally, past it or whatever.
Oh, it was serious.
Yeah.
Oh,
that it was literally the whole thing with the pinky was him doing Lorne Michaels.
I don't know. I just thought the
Canadian, right?
Yeah, Mike Myers and Lorne Michaels is Canadian as well. Yeah, Anyways, I thought that was a fascinating story.
Speaking of Wayne and Garth, have you seen that Uber Eats commercial that they have on YouTube sometimes?
Well, I see it on TV. It's not that funny. Did you like it?
I thought it was funny when they mentioned Winnipeg.
When they mentioned what?
Winnipeg.
Well, I missed that.
Yeah, I think it depends on which clip you
watch.
We've toured around, all over the place. Cities like Winnipeg, Regina, and they name all these cities in Canada.
Well, I got to watch it. I did not realize that they did that.
Yeah. So.
So they must have got together for this, right? Because they finally did this. Mike Myers looks like he's had plastic surgery, though.
To each their own.
Yeah. I have to go do a huddle puddle. I'll be right back. You guys keep talking.
Yeah. Oh, no. Whatever.
You want to call it a night?
Just wrap it. Yeah, we'll just
call
call
it.
Okay.
Yeah.
We'll have to go huddle puddle, I think.
Yeah. All right. Anyway, so that was a good show. That's and to be continued in full lockdown.
Yeah, full lockdown. We're going to be hunkered down, doing our prison walks. And
Lena had her birthday, and
you'll be celebrating yours at home.
Yeah, I'm going to be
lockdown.
Lockdown.
You were supposed to.
Whatever.
Anyways.
I don't.
Doesn't really change.
All right, Ted. Anyway, have a great weekend, everyone, and we'll be in touch.
Take care. Have a great week, everyone. See you next week.
All right, thanks, everyone.